Will the market crash in 2025? Predicting a market crash is never easy, even for seasoned economists and investors. Many factors influence market behavior: economic indicators, geopolitical events, interest rates, and investor sentiment. As we look ahead to 2025, there are reasons both for concern and for optimism. On the cautious side, global debt levels are reaching historic highs. Governments worldwide have borrowed heavily in recent years, especially during and after the COVID-19 pandemic. This excessive borrowing can lead to inflation, rising interest rates, and pressure on national economies. If central banks continue to increase interest rates to combat inflation, this could hurt corporate profits and reduce investor confidence, potentially triggering a downturn. In addition, geopolitical tensions such as conflicts in Eastern Europe, the Middle East, and increasing rivalry between major powers like the US and China can create uncertainty in the global economy. When investors fear instability, they often pull out of riskier assets like stocks and invest in safer ones like bonds or gold, which can lead to a market correction or crash. Tech stocks, especially in the US, are another area of concern. Some analysts believe that the current valuations of major tech companies are inflated. If these companies fail to meet growth expectations, a sharp sell-off could occur, dragging down the entire market. However, there are also signs of resilience. The global economy is still growing, though at a slower pace. Many companies are reporting strong earnings, and unemployment in several developed countries remains relatively low. The development of artificial intelligence and green energy technologies is opening new investment opportunities. These factors can provide a buffer against a full-blown market crash. Moreover, the market has shown remarkable adaptability in recent years. Despite multiple challenges, such as the pandemic, supply chain disruptions, and inflation, it has managed to recover repeatedly. This suggests that investors are learning to navigate uncertainty better than before. It is also important to understand that a market crash doesn't happen without warning. There are usually signs: slowing GDP growth, declining consumer confidence, high levels of margin debt, and sudden spikes in volatility. As of now, while there are risks, these warning signals are not flashing red. In conclusion, while there is always a possibility of a market crash in 2025 due to various global and economic risks, there is no definite sign that it will happen. Investors should stay informed, diversify their portfolios, and avoid panic-driven decisions. The best approach is to remain cautious but not fearful, and to prepare for different market scenarios rather than trying to predict one with certainty.